Hi folks, this is Marsilio with another video market update, and this time I'm going to do something a little different. I'm going to cover technicals and some trading on the first video, and then timing or my astro work I'm going to do in another video. So, and since it's Labor Day weekend and maybe people have a little bit more time, hopefully this is of interest. I'll see, how many people watch, click, like, etc. So I wanted to do a little bit more comprehensive technical view. Also, not only is holiday, it's just had month change. So I'm going to cover other technicals, pivots, a little bit on sentiment and valuation, and then fundamentals in this, and then trading. We'll see how long this video goes, and then a separate video for the timing work or astro. So it sounds like a lot, but I'll move through some things relatively quickly. So here we go. This is the Dow, and a couple months ago I pointed out the lower proximity to the lower monthly Bollinger Band, and that for that reason shouldn't be too bearish because it would probably bounce, which it did. Now, August, rallied further, but finished sharply lower as a down month. And we just started September, which is already in negative territory and heading lower. And what I wanted to do was point out the similarity of this pattern between the last two real deal bear markets in 2008 and then the dot-com bust. So I'm going to shift to the S&P here. The Dow is, and some other indexes, really clearly bouncing off the lower Bollinger Band. S&P was not quite there, but similar pattern. Here's the NASDAQ, slightly below the band, but closed above. That invited the bounce back up to moving averages on the monthly chart and now headed lower. So let's look at the S&P 2008 down to the lower band, a weak bounce, another move to the lower band, a better bounce up to that 10 MA, 20 MA combo, and then the real bear market started. In 2000, down to the lower band, bounced back up to 10 MA, 20 MA, another move below the band, another bounce to the 20 MA, lower, bounce to the 10 MA, lower. So in that view, if this is a real deal bear market, and in many respects it is acting like it, meaning not just a percentage drop, but extended in time, it's that COVID was down 35%, but it's really just, got over in 2 months. In any case, down to the lower band, bounced to 10 MA, 20 MA, and now headed lower. So the potential for a significant, much more significant drop in months ahead would be in accordance with these two other bear market periods that we just looked at. So this is not a forecast. This is the bearish possibility that I want to keep in mind, that we have to keep in mind, given the basic bearish configuration of most important risk assets, at least USA indexes. And here's what I mean by that. This is a simplified daily chart that shows yearly pivot, half-year pivot, quarterly pivot, monthly pivot, and standard simple moving averages, 10, 20, 50, 100, 200. And I tweeted this out earlier last week. This is the Dow, below all pivots, below all moving averages, again on the daily chart as of August 30th. S&P, same. NASDAQ, same, August 30th. Russell, due to where the quarterly pivot was holding, but also cracked as of the 2nd. NYA, institutional index, August 31st. Below all pivots, below moving averages. High yield bonds, which have been leading in the best tell this year for indexes, were below pivots, held that 50 MA. 50 MA caved on August 26th, so it caved technically ahead of the indexes. And then I know I have a lot of people who just want to know about cryptos, but we really have to understand this in the context of what's happening with risk assets. In the bigger picture, that's my view. Bitcoin, below all pivots, below all moving averages from the 19th. This looks terrible. We'll get to some more technical analysis on Bitcoin in just a minute. And then Ethereum is doing a little bit better. It is below all pivots. It's right now above 10 MA, 20 MA, which is, it's above 110, below 20, 50, and 200. So holding up, but environment of everything else going down, at some point, Ethereum is going to cave as well. So that's what I mean by technical bear market. All the main indexes, high yield bonds and Bitcoin below all pivots, below moving averages. This is where bad things happen. What's going up? Yields and a dollar. As everyone knows by now, here's the dollar. Totally, massively bullish chart. All the moving averages rising with nice slopes. The pullbacks, when they happen, down for a few days, then boom, right back to highs very quickly. Dollar just, this looks like tech used to look like, with all the moving averages rising and the pullbacks not lasting very long and just racing higher. But right now, bull market in the dollar. And then yields, maybe a little slower on Friday. There was a reversal bar in some of them, actually all three here. I just looked at the 10-year, the 30-year, the 2-year. And Friday, do the employment report, caved, but I'll cover the Fed expectations in the fundamentals section, which I'm going to do last. So the main point here is the monthly chart has a potential to stretch out in another significant bearish move in months ahead. The daily charts are all right now bearish in terms of main indexes and Bitcoin and high yield bonds. And, it's really to be like buying bottoms. This is a bear market. And my take in bear market is avoid losing money and swing. It's really not a buy and hold environment unless you're buying and holding dollar, which is not what people are doing. So I just want to get that point clear and straight away, and everything else is kind of under that umbrella. Technical bear indexes are very negative right now, and perspectives should be capitalizing on these moves via swing, avoiding losses in long-term investment accounts, or playing short side with inverse ETFs. I'm going to get that thanks to somebody who was asking about that on the Twitter feed. And because bear markets can have violent moves both directions with a lot of volatility, I recommend swing trading. So I'll talk about that as well. All right, so that's the technical picture. I do want to go back to coin a little bit on a longer term time frame. So here's the monthly chart. And I don't know why TradingView is doing that, but in any case, it always puts previous drawings on there. So previous high, the monthly chart is trying to hold that, 20,000 area, and now we're caving. So it's certainly possible that if that goes, we could just see the next high down near 13. And this monthly chart, I'm going to switch to a daily chart. This low area breaks, these closes. The low closes are really not in the 19s. 18.9 was the lowest daily close right there. This one, looks like hot, 19s. But if we get another breakdown, we're looking at the pivot levels that are in play are around 18, about 15.9, and then around 12.13. So I'm just pointing out the potential here. And then once I review the Astro, I'll come up with what I think is the most likely move. But I think that Bitcoin has been trying to hold this 20K area for a while now, June, July, August, here we are, September, back under 20K again. And given Astro ahead, I think it's more likely to bet on a cave than a rally. Let's get that clear, because everything else is bearish as well. Ether doing better, certainly technically on the longer time frame and on daily, still above. It's not near the lower band, still well above the monthly rising 50 MA there. Also trying to hold one move below the prior high. Looks like maybe the monthly close high was support. Yeah, but there's no reason we could easily see another move down, below this 1500 area. I just don't think in an environment where everything is caving that Ethereum is miraculously going to hold up, especially if Bitcoin's going lower. At least that's what I think right now. Okay, so other technical, we've covered larger technical picture, the pivot status, and I want to look at sentiment and valuation just a little bit. This is many tools for sentiment, but this is more closely tied to indexes, but there's more money in indexes. I think this is what matters. This is a 10 MA and a special faster moving Hull moving average that's in orange. The 10 MA is in blue. Just basic put call on, we're looking at a daily chart right now. And here I've just shifted to a weekly chart. All this call buying, lack of puts during the Fed. I mean, that was the right move. The market was screaming higher, and these people made a lot of money. And now with the Fed reversing, markets reversing, this is kind of coming back into historically normal territory. But what I want to point out is that the level the weekly chart is now is really just in the middle of the range. So this has potential to go much higher and probably should. So even though it looks high for this year, if we look back, it's just mid-range. And then daily chart, kind of similar, even though it looks high and Hull's already back pushing the band, it's not really high compared to where it went on market bottoms 2015, 16, 17, 18, 19, and now we have a Fed that's hiking. So my point about the sentiment is, although put call looks high if we only look back from 2020 on, but if you look back from 2015 on, it's not really that high. And I think we have to expand our look back period, given that 2020 through end of 2021 was really the aberration, considering the Fed policy and QE, and the other years were a little bit more quote unquote normal. And then valuation, which I like Yardeni's work, and I've been doing a mini version for myself for many years after seeing his stuff. I'm not going to get into expand. This is forward PE. It's above 15. The latest FactSet report, I believe, was 16.7. And I saw some link to on Twitter, I think, or some article that previous bear market lows were below 15, which is true. This is the bear market low here, which is near 10. And then in 2000, the bottom was a little bit below 15, not by much, but a little bit below. So and then here's my own version. It's just a kind of crude Excel spreadsheet. I probably need to get this in Tableau or something. But anyway, if we saw 14 area, which is not inconceivable, the 2018 low was near 14 and the initial COVID crash reached 13. So let's just say 14. If we saw 14, that would be about 3,400 S&P right now. And even if we reach 15, the previous drop stopped a little bit above 15. If we reach 15 again, that would be 3625. Although these are starting to roll over with negative slopes as they do in the more bearish environments, and they're going to go lower. So in bull market, they're climbing, companies are increasing earnings, but in bear market, they roll over. And so if we think in the future, well, it looks like 15 is 3625 now, but maybe by the time we get there, it's more like 3,500 or something like this. But now I'm going to go back to the S&P chart on a weekly basis. And so we just said, okay, 14, 30, 3,400, 15, 3,600. Where is that? Well, 3,600 would be down here. This is very doable. And I'm not talking necessarily September. I'm talking about anytime in the next 6 months. That would still be above the weekly 200 moving average. If that goes and we see 3,400 or less, it'll be down here, which just can't be ruled out. Everything is bearish, and even this weekly MACD down, weekly chart also below all moving averages. No, excuse me, not true. Above all moving averages except the 200 in the weekly chart. Okay, so covered other technicals, pivots, sentiment via put call, pointing out that if we just look at prior years from 2015 to 2020, it has room to go higher. And then the valuation has room to go lower and should go lower if we reach value areas similar to other, major declines in the market, which would be 15 or lower on forward S&P. So now I'm going to go to the Fed, and you might argue probably I should cover the Fed first. And of all my astro work and technicals, et cetera, I think, look, if I had to do it all over again, I'd just start with the Fed because all the zero interest rate policy markets are just going up and up and up. And no wonder there was a Fed obsession, because it just, institutional investors and all the hedge funds are just following the Fed. A few charts here. We've got, this is the 210 yield curve. I mean, this to all the institutional players means recession is coming. That's going to keep on hiking until that happens. The other reason they have to keep hiking is because this is the Fed funds rate. Fed funds rate is 225, 250. I don't know why this chart is a little slightly, actually this is showing 2 1/3, which is where it was, before COVID. Problem is inflation is up here. It's still, inflation's over 8. Even if inflation peaks and comes down near 5, Fed has to keep hiking. And so I think, the chances of a more significant move lower in months ahead are high. So this is the Fed probability. Some people are starting to think that given the data, maybe they'll only hike 50 basis points. This has been flopping around. It really came down quite a lot on Friday. I think prior to Friday, it was up. It was increased, and people were, again, expecting 75 basis point hike. I think as long as there's such a huge discrepancy between CPI and the Fed funds rate, they have to get it up there. And the other thing that's going on is the balance sheet unwind, which reached, nearly $9 trillion and just starting to come down. And I saw a story about the pace of QT doubling, QT meaning qualitative tightening or reduction of this balance sheet, doubling in September. And I just think it's absolutely no coincidence that all these daily charts caved technically right at the end of August. Like, institutions are paying attention to this. And so there we have it. QT increasing in September. All charts are bearish, and sentiment is not really near any kind of extreme. So what to make of all this? How to turn this into an environment where it's actually, the reason why we're doing all this is to avoid losing money and make money regardless of environment. And there are many ways to do this. There are all kinds of vehicles. And I personally like the inverse ETFs for like an IRA account. And then for a trading account, I like futures. I probably should do more with options in certain circumstances, but I would do that if I was part of a larger team, because certainly my work could benefit from options, but I like futures. And like I said, I'm just one person here. So, this work is very suitable to the options market because you have price and time, and timing is really the key with the options. The thing with the options is you really have to know what you're doing and be watching them very carefully, because in a sideways market, you lose money. A lot of options contracts go to zero, so you have to get direction and time and magnitude. And then you have funny things going on with the VIX. In any case, I'm just going to cover the inverse ETFs and futures here a little bit in this video. So the ETFs, they're obviously SPY, most common is tracking S&P index, but there is also inverse that you can buy, the one that goes up when the S&P is going down. And then you can also buy double up or down or triple up or down. And I like these, but the more you go up in leverage, the more you have to be watching carefully, not be late on entries, and also not be late on exits, because the inverse ETFs really kill you when the market bounces. And they're not, especially the bear market inverse, are not for long-term holds. I have read stories of people doing long-term holds on the bullish ones and making, phenomenal money on a very long-term. And if you look at the chart of like TQQQ, for example, you can see what that did over like 10 years, but probably has lost so much of the gains. Again, the leverage ETFs, you cannot be sleeping on entries and exits. But if you have the time and the kind of fascination with this game, they're the much better ways to play it. So the 4 main indexes, Dow, S&P, NASDAQ, Russell, all have double, triple, long and short ETFs available with plenty of volume. And now that commission are free, it's really phenomenal opportunities with all these swings, even on a daily chart basis, where you can just check things at close and, either do it like on lunch hour if you're on Pacific time, or early the next morning if you want to have a portion of your account that's more actively managed. And here's how I think about it. Of these four, well, my personal perspective is if you have a watch list of 50 things, you're going to spend a lot more time trying to figure out, which is the best one, which is the best long, which is the best short. It doesn't matter as much. It's better to have a few that you're watching carefully and executing well than 50 things that you're taking so much time tracking them that you miss moves. So I think there's plenty of room just to do these four. And then in longs, you want to go with what's technically strongest and shorts technically weakest. Let's see, I'll go to the basics and do this on these ETFs. So the Dow was all the way up above its 200 moving average and nearly tagging the yearly pivot. It was technically strongest at the time. But if you're thinking, okay, the rally might stop here, but do I want to short the Dow? Well, you could have, but if we go with the idea of shorting the weakest, here's S&P, tag the 200, weaker than the Dow, not as high as the yearly pivot, so but above the other moving averages. I think you can use a combination of the pivots and moving average. Here's QQQ, did not reach its 200 moving average, so weaker in that regard. And then looks the first time below moving average would have been the 19th. I think all of them, that was QQQ was below its 10 MA before the others. So not as high, according to technicals on the rally, below moving average first. There's your short. At least that's how I think about it. And looks like Russell could have also done the Russell, although it made it to its 200. So, toss up there. So that's how I think about the ETFs. And then futures, this video has gone along a little bit longer, so I'm not going to, maybe I'll save this for another monthly video. I really like the micro contracts. If you don't know what I mean by this, you can search. So, there was a time, several years ago now, but there was a time I was at a small hedge fund and I was mostly doing strategy work like I'm doing now. But the head trader wanted me to adjust the total margin, total long exposure, short exposure at the end of the day based on the New York Stock Exchange close. And he would send me messages like, short 700 ES contracts, do your best. And for those who know a little bit about the game, that is a big number. ES is $50 a point. So for 700 times 50 per point, it's a lot of money flopping around. But if you're running, $100 million fund, which is actually a small hedge fund, anything less than that is kind of inconsequential. But so that's the big boy game and what they're doing with these futures contracts. But $50 a point is a lot, especially in these ranges. And unless you have a very large trading account, you can't scale in and out, which is the much better way to play it. Trading is much, much better when you can size and say, well, this is an okay setup. I'm not sure about the timing, but it's a long, I'll try it with 2 or 3 units. Or this is a fantastic short setup. Everything is lining up short. I'm going to go, 10 units. You can't do that with or you need a much bigger account to do that with the big futures contract. But the micro futures contract is 1/10 the size. It's only $5 a point on the ES. And you have the same options. You have futures on Dow, S&P, NASDAQ, and Russell, all the same. And you can scale in and scale out. And you don't get killed by terrible gaps. And you can enter in the evening or in the morning before you go to work, or I'm assuming a lot of people watching have regular jobs. And they're 24/7, from the Globex Open, which is Sunday, 6 Eastern, 3 Pacific, all the way up to Friday close. Except there's a brief period after New York Stock Exchange close that they're not active, but mostly you can adjust your stops anytime, enter, exit anytime. So I really like the micro futures. That's why I've just focused on futures instead of options, which also you get killed on gaps. So if you haven't looked at futures before and interested in putting this work to some better use, I recommend and start small. Start with a micro, one contract. It's only $5 a point. If that's too much for you, then forget it. And then Interactive Brokers is what the pros use, but TradingView also has some other brokers I've been meaning to check out for a long time because they have point and click applications on the screen, which pretty good. But if Interactive Brokers is a publicly traded company, it's what the pros use. The reporting is excellent. It's a little bit of a hassle to set up, but at least you know your money's safe. And they're the biggest and most reputable futures broker that I'm aware of. So hopefully all that's helpful. And yeah, maybe I'll cover a little bit more about futures trading, some future video. I think this has gone on long enough, but I'm going to cover the timing work in the next video and then come up with a bias for the week ahead. So if you're interested in that, and that does require some astro fluency to follow what I'm saying, then check the next video. Thank you very much and good luck.